Here's something that will make you question everything you think you know about financial markets. The United States government, right now today, in federal law values your gold at exactly $42.22 per ounce. Meanwhile, that same ounce trades on global markets for approximately $4,100. That's not a typo. That's not some forgotten website. That's public law 93 to 110. Still on the books, officially pricing gold at less than 1/100th of its actual value. Why does this matter? Because this absurd discrepancy reveals something profound about monetary systems, government accounting, and the fundamental disconnect between paper valuations and real assets. And that disconnect is about to become the most important investment concept you'll ever understand, scanned through a century of financial catastrophe. The deflationary nightmare of the 1930s that vaporized nearly 90% of equity values, the brutal stagflation of the 1970s that gutted bonds and savings accounts, the systemic collapse of 2008 that erased $10 trillion, the pandemic's 3-week freefall in 2020 that dropped markets 35%, the 2022 interest rate shock that crushed growth names by 70%. 5 completely distinct crises. Each one required different analysis, different timing, different expertise. Depression economics versus inflation. Dynamics versus credit freezes versus pandemic lockdowns versus monetary tightening. Totally separate playbooks. Yet across all 5 disasters, 3 specific positions survived intact. Not for strategies, not 10 diversified approaches, 3 positions. The exact same 3 that preserved wealth in 1929 preserved wealth in 1973, in 2008, in 2020, in 2022. These aren't sophisticated instruments. They're not exotic derivatives. They're 3 positions available to anyone with a brokerage account. Right now, Warren Buffett maintains approximately 30% of Berkshire Hathaway in the first position. But he just increased that to $381 billion, the largest defensive stance in the company's history. Global central banks continue purchasing the second position at rates not seen since 1950, and despite every panic, every sell-off, every crisis. The third position has delivered roughly 10% annual returns for over a century. Most investors never hold these 3 positions. They chase momentum, they concentrate bets, they panic during crashes and sell at bottoms. They lose everything because they don't understand one critical truth. The pattern matters more than the prediction. You cannot predict which crisis comes next: depression or inflation, market crash or currency crisis, war or pandemic. But you can position to survive whatever arrives, because these 3 positions address the only 3 states that financial markets can exist in, regardless of which specific crisis creates those states. Understanding this pattern gives you what most investors never possess: survival certainty. Not certainty about what happens next. Certainty that when something does happen, your capital survives. And survival is everything, because only survivors have capital to deploy at crisis bottoms. That's where generational wealth gets created. Financial markets operate in 3 fundamental conditions. Every crisis in history represents one of these states or a transition between them. State 1. Deflation and crisis prices fall. Assets decline. Cash becomes the ultimate asset because everything else is losing value. You need liquidity to survive the cascade and capital to deploy when blood runs in the streets. Think 1929 to 1933, when deflation made a dollar more valuable as prices collapsed 25%. Think March 2020, when everything sold off in panic and cash was the only thing that worked. State 2. Inflation and debasement currency loses purchasing power. Governments print money. Paper assets get destroyed. You need hard assets that cannot be inflated away, cannot be printed into existence, cannot be devalued by central banks. Think 1970 to 1980, when inflation ran 7 to 13% annually and traditional savings got obliterated. Think 2020 to 2021, when stimulus flooded the system and inflation roared back. State 3. Growth and recovery. The economy expands, productivity increases, businesses generate earnings. You need ownership in productive assets that compound over time, that participate in economic expansion, that grow alongside innovation. Think 1982 to 2000, the greatest bull market in history. Think 2009 to 2020, when owning American business turned $100,000 into $500,000. Every crisis falls into one of these 3 states. The three positions protect you in each state. Position 1 handles deflation. Position 2 handles inflation. Position 3 captures growth. Together, they ensure you survive any condition markets can produce. This is what Ray Dalio termed the crisis-proof fortress, not because it maximizes returns in every environment, but because it never fails in any environment. And in investing, never failing matters more than occasionally winning big. Because the investors who never fail are the investors who have capital when assets go on sale. And buying at sale prices is how ordinary wealth becomes extraordinary wealth. Let me show you exactly how these three positions performed through 5 completely different disasters. The ultimate deflation scenario, the worst economic disaster in modern history. Let's track the three positions. Position 1, cash and treasury bills in 1929. The dollar was backed by gold at $20.67 per ounce. When markets crashed in October, stocks began an 89% collapse that bottomed in 1932. But cash didn't fall. It gained value. Deflation meant a $1,929 bought more in 1932 because prices had fallen 25%. Real purchasing power increased 25% by doing nothing except holding cash. Treasury bills delivered 3 to 4% nominal yields while prices fell 25%. That's 28 to 30% real returns. Extraordinary performance from the safest instrument on earth. But the real power of cash came at the bottom. In 1932 and 1933, stocks traded below the cash on corporate balance sheets. Entire buildings sold for the price of their lobbies. Investors who held cash through the crash deployed at fire sale prices. Bernard Baruch maintained cash reserves through 1929 to 1931, deployed in 1932, 1933, and by 1936 had more wealth than before the crash. Cash preserved capital and created deployment optionality. Position 2, gold remained fixed at $20.67 per ounce until 1934, preserving wealth in dollar terms, but in 1934, Franklin Roosevelt devalued the currency. He revalued gold from $20.67 to $35 per ounce. Overnight, gold holders saw a 69% gain. This is gold's fundamental property. Governments cannot devalue gold. They can only devalue their currencies relative to gold. Investors holding gold through the Depression. Position 3, the S&P 500. This seems counterintuitive given the 89% crash, but time horizon is everything. By the S&P in 1929 at the peak, hold through the crash, and by 1945, you're back to even with dividends reinvested. By 1950, you've doubled your money. By 1960, you've quintupled. Depression lasted 10 years. The recovery lasted 30 years. Investors who held American business through the Depression and into the recovery created generational wealth, not by timing bottoms, but by owning productive assets for the long term. Three positions: cash preserved and deployed, gold preserved and gained, stocks compounded for those who held together survival and eventual prosperity through the worst crisis in history, the opposite of the Depression. Not deflation, but inflation. Not falling prices, but rising prices, where most portfolios died. Position 1, cash and treasury bills. Cash lost in nominal terms, as inflation ran 7 to 13% annually. But treasury bills adjusted. Yields rose to match inflation, eventually hitting 15% by 1981. Investors who held short-term bills and kept rolling them over matched inflation. They didn't get rich, but they didn't get destroyed like bondholders who watched 30-year bonds lose 50% in real terms while paying 3 to 5% yields. Treasury bills kept adjusting higher, preserving capital in real terms. Position 2, gold. This is where gold proved its inflation hedge credentials. Gold began the decade at $35 per ounce. When Nixon closed the gold window in 1971, gold started rising. By 1974, $200. By 1978, $300. By January 1980, $850 per ounce. A 24 times gain in 10 years. Anyone holding 10% of their portfolio in gold watched that position grow to 50% by 1980. Gold didn't just preserve wealth during inflation, it multiplied wealth. This is position 2's purpose. When governments print money, when inflation runs hot, gold becomes the ultimate store of value. Position 3. The S&P 500 stocks struggled in real terms. The S&P went sideways from 1968 to 1982, 14 years of flat performance. With dividends reinvested, you still made 5 to 6% annually. But that's below inflation, so you lost purchasing power. But here's the key. In 1982, when inflation broke and Paul Volcker raised rates to 20%, when everyone was terrified, stocks bottomed. From 1982 to 2000, the S&P returned 17% annually, the greatest bull market in history. Investors who held through the 1970s participated in that boom. They didn't get rich in the 1970s, but they positioned for the 1980s and 1990s. 3 positions. Treasury bills adjusted to preserve capital. Gold exploded 24 times during inflation. The S&P survived and positioned for the next cycle. Together, survival through the opposite crisis, the second worst financial crisis in history. The entire banking system nearly collapsed. Position 1. Cash and Treasury bills when Lehman Brothers failed in September 2008. When AIG received emergency bailouts, when the financial system came within hours of complete collapse, only one thing mattered. Liquidity. Credit markets froze. The money market fund broke the buck. But cash worked. 3-month Treasury bill yields went to zero because everyone rushed to safety. Returns didn't matter. Survival mattered. Warren Buffett held $40 billion in cash entering the crisis. That cash enabled legendary investments. $5 billion into Goldman Sachs in September 2008, $3 billion into GE, $5 billion into Bank of America in 2011. Those investments made Berkshire tens of billions. Cash in crisis isn't about returns, it's about optionality, the ability to act when everyone else is paralyzed. Position 2. During the initial crash in September-October, gold fell to $700 as everything got liquidated for cash. But then the Federal Reserve acted quantitative easing. The Fed printed $1.5 trillion. Gold reversed sharply. By 2011, gold hit $1,900 per ounce. Anyone holding gold through 2008 captured the Fed's inflationary response. Gold anticipated money printing and preserved purchasing power. Position 3. The S&P 500 brutal. The S&P fell 57% from October 2007 to March 2009. Anyone holding stocks lost more than half their wealth on paper. But the pattern repeats. Hold through the bottom, and the S&P recovered everything by March 2013 for years to break even. Then it kept going. From March 2009 to February 2020, the S&P returned 400%, the greatest bull market since the 1990s. Investors who held who didn't sell at the bottom, who reinvested dividends, created generational wealth. $100,000 invested in 2009 became $500,000 by 2020. 3 positions. Cash allowed deployment at the bottom. Gold captured the inflationary response. The S&P compounded for a decade. Together, not just survival, prosperity. The fastest crash in history. The S&P fell 35% in 3 weeks. Position 1. Cash and Treasury bills. Cash was the ultimate asset during the crash, when markets fell 10% in a day, when circuit breakers halted trading. When panic ruled, cash provided optionality. Bill Ackman held cash before the crash. He bought $27 million in credit default swaps. Those swaps paid out $2.6 billion. He immediately deployed that cash into crashed stocks, Starbucks, Hilton, Lowe's, Chipotle, at 40 to 50% discounts. Within 4 months, those positions doubled. Cash during crash allowed the greatest rapid deployment opportunity in modern history. Position 2. Gold started 2020 at $1,550 per ounce. During the March panic, gold fell to $1,450 as everything got sold for liquidity. By August 2020, gold hit $2,070, a 42% gain from the lows in 5 months. Why the Fed printed $4 trillion? The government sent stimulus checks. Inflation was coming. Gold anticipated it. Anyone holding gold preserved wealth during the crash and gained wealth during the recovery. Position 3. The S&P 500 fell from 3,400 in February to 2,200 in March 30, 5% in 23 trading days. The recovery was faster. By August 2020, the S&P was back at all-time highs. 4 months to recover. By February 2021, up 100% from the bottom. Investors who held captured the entire recovery. 3 positions: cash for deployment, gold for the inflationary response, S&P for the recovery. Same pattern compressed into 1 year instead of 10. A different crisis. Not deflation, not inflation spiral. A transition: the Fed raising rates to fight inflation. Position 1. Cash and Treasury bills. This is where Position 1 dominated. Treasury bill yields went from 0 in January 2022 to 5% by December 2022. For the first time in 15 years, cash paid a real return. While stocks fell and bonds crashed, Treasury bills gained value. Move to bills in January 2022, make 5% that year, while the S&P fell 18% at 23% outperformance. Cash preserved capital and paid income. Position 2. Gold struggled in 2022. Started the year at $1,800 per ounce. Ended at $1,750, or 3% loss. Why? Rising interest rates make non-yielding assets like gold less attractive. But gold didn't crash. It didn't fall 50% like bonds did. It preserved most of its value. And in 2023, gold began rising again, hitting $2,300 by mid-2024. And as of November 2025, gold has surged to approximately $4,100 per ounce, record territory. Gold's role in 2022 wasn't appreciation, it was preservation. Position 3. The S&P 500. The S&P fell 18% in 2022. Growth stocks fell 30 to 70%. Technology names got destroyed, but dividend-paying stocks held up better. Utilities, healthcare, consumer staples fell only 5 to 10%. In 2023, the S&P roared back, up 25%. Anyone who held through 2022 captured the 2023 recovery. 3 positions. Treasury bills paid 5% and preserved capital. Gold preserved wealth without crashing. The S&P fell but recovered quickly. Together, the 3-position portfolio fell maybe 5% in 2022, while most portfolios fell 20 to 30%. Relative outperformance through diversification. What makes these 3 positions special? Why do they work across every crisis? Position 1. Cash and Treasury bills. Cash is optionality, the ability to act when others cannot. When markets crash 30, 40, 50%, when assets go on sale, when everyone else is forced to sell or frozen in panic, cash allows you to buy. Warren Buffett says his favorite holding period is forever, but his second favorite is cash during crisis. Because cash in crisis becomes the most valuable asset, not because it appreciates, but because it allows action. Treasury bills are slightly different. They're cash that pays interest. The yield adjusts to market conditions. When inflation is high, Treasury bill yields rise. When deflation hits, bills preserve value. They're the most liquid, safest asset in the world, backed by the United States government, which can print dollars to repay them. This makes Treasury bills the ultimate defensive position. How much should you hold? The smartest investors provide guidance. Warren Buffett, at Berkshire Hathaway, currently holds approximately 30% in cash. And bills, and, as of November 2025, that's grown to $381 billion, the largest cash position in Berkshire's history. Ray Dalio recommends 5 to 10% in normal times, 30 to 40% when valuations are extreme. The purpose isn't maximizing returns, it's maintaining dry powder, capital to deploy when opportunities arrive. And opportunities arrive when markets crash. Position 2. Physical gold. Gold is the only asset with 5,000 years of history as money. Empires have risen and fallen. Currencies have been created and destroyed. Gold has maintained value across all of it. Why? Unique properties. Gold cannot be printed, cannot be digitally created, requires physical mining, supply is limited, demand is constant. When fiat currencies are debased through money printing, gold appreciates. When financial systems collapse, gold is accepted everywhere. When inflation runs hot, gold preserves purchasing power. The 1970s proved this. Gold went from $35 to $850. The 2000s proved it again. Gold went from $250 in 2001 to $1,900 in 2011. And right now, gold is proving it once more. As of November 2025, gold has surged to approximately $4,100 per ounce, all-time record highs. Why? Because central banks globally are accumulating gold at the fastest rate since 1950. China, Russia, India, Turkey, Poland all buying. They see unsustainable debt, inevitable money printing, and they're diversifying out of dollars into gold. How much should you hold? Ray Dalio recommends 5 to 10% of your portfolio in gold, not gold mining stocks, which are leveraged bets. Physical gold, or gold ETFs like GLD, that hold actual allocated gold. The purpose isn't speculation, it's insurance. When fiat currencies devalue, when the Fed prints trillions, when debt becomes unsustainable and inflation accelerates, gold protects your purchasing power. Position 3, the S&P 500 Index. The S&P 500 is ownership in the 500 largest American companies. Apple, Microsoft, Google, Amazon, Berkshire Hathaway, Johnson & Johnson, Visa, Procter & Gamble. These companies generate earnings, pay dividends, innovate, grow. Over the long term, the S&P 500 has delivered 10% annual returns for over a century. Through the Great Depression, World War II, 1970s stagflation, the 2000 tech crash, the 2008 financial crisis, COVID, every crisis, the S&P has recovered and reached new highs. As of November 2025, the S&P 500 has climbed to approximately 6,700 points, marking new record territory. Why? The S&P represents the American economy, and the American economy has grown for 250 years. Recessions happen, crashes happen. But over time, innovation, productivity, and population growth drive earnings higher. Higher earnings drive stock prices higher. Investors who hold the S&P through crashes, who reinvest dividends, who don't panic sell, compound wealth at 10% annually. That doubles your money every 7 years, quadruples every 14 years. Over 30 years, a 10% return turns $100,000 into $1.7 million. The key is time horizon. Need the money in 1 year. Don't hold the S&P. It can fall 30% in any given year. But if your time horizon is 10, 20, 30 years, the S&P is the best long-term wealth compounding machine ever created. Warren Buffett has said that for most people, an S&P 500 index fund is the best investment they can make. Not stock picking, not market timing, just owning American business for the long term. How much should you hold? Depends on age. Age 30, you can hold 80 to 90% because you have 30 years to recover from crashes. Age 60, maybe 40 to 50% because you need more stability. But everyone should hold some S&P exposure because over any 15-year period in history, the S&P has never delivered a negative return. It always recovers. It always reaches new highs. Position 3 is the growth engine that compounds wealth over time. Right now, as of November 2025, the smartest investors in the world are positioned in these exact 3 assets. Their positioning reveals everything you need to know about what's coming. Position 1, cash and treasury bills. Warren Buffett at Berkshire Hathaway is holding $381 billion in cash and treasury bills. That's approximately 31 to 33% of Berkshire's total assets, the largest cash position in Berkshire's history, up from $325 billion just months ago. Buffett has been selling stocks to raise this cash, reduced his Apple position by 67%, selling Bank of America, not buying anything. In recent communications, Buffett indicated he cannot find anything attractively priced. Translation: everything is overvalued. Stay in cash, wait for the crash, then deploy. This is the same pattern Buffett followed before every major crash. In 2007, Berkshire held $40 billion in cash. The crash came in 2008. Buffett deployed. Goldman Sachs, Bank of America, GE made billions. In 2019, Berkshire held $120 billion in cash. COVID crashed markets in 2020. Buffett deployed. Now Berkshire holds $381 billion. The pattern says the crash is coming. Buffett is ready. Position 2. Gold. Central banks globally bought over 1,000 tons of gold in 2022, over 1,000 tons in 2023, over 1,000 tons in 2024. China's official gold reserves have increased from 1,000 tons to over 2,000 tons, but analysts believe China holds far more in unreported reserves. Russia liquidated U.S. Treasury holdings and bought gold. Poland doubled its gold reserves. Singapore, Turkey, Indial accumulating. Why? They see what billionaire investors see. America's federal debt has now reached $38.09 trillion, growing by over $2 trillion in just 1 year. The Fed will have to print money to manage that debt. Printing money devalues the dollar. Gold protects against that devaluation. These central banks are executing position 2 at massive scale, and billionaire investors are following. Ray Dalio holds 5 to 10% in gold. Paul Tudor Jones has disclosed gold positions. Stanley Druckenmiller owns gold. The smart money is in position 2 right now. And gold's surge to approximately $4,100 per ounce in November 2025 proves they're right. Position 3, the S&P 500, despite all the concerns about crashes and bear markets, long-term investors are still holding the S&P. Why? Because over time, it always recovers. Right now, the S&P 500 has climbed to approximately 6,700 points near all-time highs, continuing its relentless advance despite mounting concerns. But here's the key. Long-term investors aren't selling. They're holding because they know timing the market is nearly impossible. The best strategy is to hold through volatility and buy more during crashes. Warren Buffett holds Apple, Coca-Cola, American Express, Bank of America. He's not selling these positions. He's just not buying new ones because valuations are high. But he's holding position 3. Ray Dalio's investment funds hold significant S&P exposure. The smart money isn't abandoning position 3. They're just balancing it with positions 1 and 2. So what should you do? How should you position right now in November 2025? Here's the actionable allocation based on the pattern. If you're under 40 years old, 20% in position 1, cash and treasury bills. This gives you ammunition for when the inevitable crash comes. 10% in position 2, physical gold or gold ETFs. This protects against inflation and currency. 70% in position 3, S&P 500 index fund. You have time to recover from any crash. You want maximum exposure to long-term growth. If you're 40 to 60 years old, 30% in position 1, cash and treasury bills. More protection as you approach retirement. 10% in position 2, gold, same inflation protection. 60% in position 3, S&P 500. Still substantial growth exposure, but more defensively positioned if you're over 60 years old. 40% in position 1, cash and treasury bills. You need stability. You cannot afford to lose 50% right before retirement. 10% in position 2, gold, inflation protection remains important. 50% in position 3, S&P 500, still meaningful growth exposure, but balanced with safety. These are the 3 position allocations that have worked through every crisis. They're not exciting. They don't promise 1,000% returns. They promise survival, preservation, and long-term compounding. And that's what builds wealth over decades. Here's how to execute this. For position 1, open a brokerage account and buy treasury bills directly, or use a money market fund that invests in bills. Current yields are in the range of 3.5 to 4% real returns with 0 risk. For position 2, buy physical gold from a reputable dealer, or buy GLD, the largest gold ETF or IA. Make sure it's allocated gold, not paper gold. You want actual physical gold backing your position. For position 3, buy SPY, VOO, or IVVTs, our S&P 500 index ETFs that track the index exactly. Set up automatic monthly purchases, dollar cost average into the position. Don't try to time the market, just accumulate consistently. This is not financial advice. I'm not a financial advisor. This is pattern recognition based on historical data. You should consult with a qualified financial professional before making any investment decisions. But the pattern is undeniable. 5 crises, 3 positions. They survived all of them. 5 completely different crises across 100 years. The Great Depression destroyed stock wealth, but cash and gold survived. The 1970s stagflation destroyed bonds, but gold exploded and treasury bills adjusted. The 2008 financial crisis crashed stocks, but cash allowed deployment, and gold captured the Fed's response. COVID crashed everything for 3 weeks. Then stimulus drove recovery. 2022 killed growth stocks, but treasury bills paid real returns and preserved capital. Through all of it, 3 positions survived. cash and treasury bills for optionality and deflation protection, physical gold for inflation protection and currency debasement insurance, S&P 500 for long-term growth and compounding. Not for positions, not 10 strategies. 3. Simple, stress-tested, proven across a century of crises. And right now, in November 2025, the smartest investors in the world are positioned in these exact 3 assets. Warren Buffett holding $381 billion in cash, an increase of $56 billion in months. Central banks buying over 1,000 tons of gold annually. Gold surging to approximately $4,100 per ounce, record highs. Long-term investors holding the S&P at approximately 6,700 points, despite volatility. The pattern is repeating. The positioning is clear. The only question is whether you'll recognize the pattern and position accordingly, or whether you'll chase returns, hold concentrated bets, and panic during the next crisis, losing wealth you could have preserved. Most people will ignore this. They'll believe they can time the market perfectly. They'll believe their stock picks will outperform. They'll believe the next crash won't affect them, and they'll lose 30, 40, 50% when the crash comes. But a small group will see the pattern. They'll position in the 3 assets that survive everything, and when the crash comes, they'll preserve capital, maintain purchasing power, and have ammunition to deploy at the bottom. Then they'll compound for the next decade while everyone else is recovering losses. The 3 positions aren't promising exponential returns next year. They're promising survival through any crisis and approximately 10% compound returns over decades. That turns $100,000 into $1.7 million over 30 years. That's generational wealth built through pattern recognition and discipline. The next crisis is coming. It always is. And when it comes, you'll want to be positioned in the 3 assets that survive everything. Not panicking, not selling at the bottom. Surviving and thriving while everyone else learns the pattern the hard way. This is pattern recognition. 5 crises, 3 positions. A century of proof